Hello and welcome to Hedge Fund Tips with Tom Hayes for the week ending July 17th, 2020. Quite a busy week. This is VideoCast 39 and podcast episode 29. So as we always like to start with, a little bit of the media because I cover my best ideas there, and then we'll work into the data and the articles moving ahead. So thanks for joining us, and want to start out on Monday. I was on Fox Business with Liz Clayman for the Clayman Countdown. Thanks to Liz Clayman and Ellie Terrett for having me on the show. And that was a great episode segment because they asked me to talk about, they put out a bunch of stocks that were trading at 100 times multiples. And I basically came on and said that they were pointing out tech and semiconductor stocks that were trading at 100 times multiples. I said, listen, semiconductors are priced for perfection. Banks are priced for the apocalypse, neither of which will probably happen. So it just showed the extreme divergence between value and growth. And we've seen the push-pull the last couple of months. And I talked a little bit about when value outperforms versus when tech outperforms, tech and growth versus value and cyclicals. And the key thing is when the recovery looks like it's going fast, like it was in May, value and cyclicals outperform, and you saw they had a monster run in May. Then the cases spiked up in the Sun Belt towards the mid-June to early July, and that implied that there were going to be some areas that had to re-shut down certain parts of their business, which means the recovery was going to be slower. And guess what? Money rotated right back into tech. Yields came down. And when growth appears like it's going to be slower, or the recovery appears like it's going to be slower, people are willing to pay up whatever they have to for the small pockets of growth that can do well if there's a slower economic recovery. So that was a really good segment that we went through. And the other thing that I laid out to Liz, which she agreed with, was that historically, if you look back at the data, paying up 100 times for earnings for any stock, with very few exceptions, usually doesn't end well 1 to 2 years later. There's no question they can go higher in the short term, but that has historically underperformed over time. So that was a great little segment. Grateful to Liz Clayman and Ellie Terrett for having me on that. Also on Monday morning, Meta Singh and Devik Jain called me for a quote in their Reuters article. Thank you for including me, Meta and Devik. And the quotes that they chose from our conversation was, there are renewed expectations that the Pfizer vaccine will be ready for approval by the end of October, which is sooner than expected. So that's very good news. And then the second quote was, the market is sniffing out that the worst is behind us and is looking forward to earnings and guidance, which will more than likely beat very low expectations. So this was Monday before earnings started. We're going to go comprehensively into how companies did this week, but that proved to be correct. Then on Tuesday early morning, which was the closing bell for CNBC in Indonesia, I was on, and that was with Maria Katerina. Thank you for having me on your show. And Yolaiwan Haryana was invited me on. So this one was a really interesting experience, CNBC closing bell, because most segments, on Fox, it's the floor show. It's quick, it's snappy, it's a couple of minutes. Most segments on other stations are like 4 to 6 minutes is the normal range. This one I got on and we started going back and forth. I got on, I guess, around 4:30 their time. And then like the first commercial break came in, 4 to 6 minutes later. And Maria said, we'll be back with Tom Hayes, chairman of management. I was like, okay, maybe they want another minute. Long story short, we went through 3 commercial breaks. The whole entire, basically half hour, it was 21 minutes excluding commercials. Very exciting, very grateful for that. And we covered quite a few things that I normally don't talk a lot about because the audience was emerging markets and Indonesia. So I do want to go into a few of those points, and with all of these segments, you can go up to on hedgefundtips.com, click on the button that says featured on, and it brings up all of the appearances in order of importance. And the reason these are important is not because it's TV. It's because of the preparation that has to go in to get ready for the show. I go through a lot of my data and I synthesized everything I'm thinking about, pages of data that I look at on a daily basis into, 4 to 6 minutes. So it really is kind of like having a Cliff's Notes of what's happening now to review some of these segments, because, it helps my thinking in investing, and I hope it can be helpful for you as well. But in this segment, we went into quite a few things that I didn't expect to. First and foremost was because of the region. They wanted to know what I thought about U.S.-China relations. And my basic theme there was, yes, you have the issues over the South China Sea. You have the issues over the public company listings. You have the frustration over COVID. You have all of the Hong Kong issues. All of those are legitimate. But right now, the relationship boils down to one thing and one thing only. And that is, are both sides following through on the phase one commitments? In the case of China, it's the purchases from the United States, the ag purchases, the energy, the commodity purchases, etc. And they are. And what was interesting about that, and I also talked about it on China Global, which we'll talk about in just a minute, but towards the end of the week, China came out after some back and forth over major issues and sanctions, bilateral sanctions on both sides, and basically said, we are sticking with phase one. We'll deal with what they labeled was bullying. We'll deal with that separately, but we're holding pat with phase one. So long as both sides stand pat on phase one and keep that moving forward, all of the other rhetoric like they had with the U.S. flights got resolved a couple weeks ago. These type of things I think can be worked through over time. It's so long as that trade deal stays in place, that the relations will be fine. The next issue that we covered was the U.S. stock market overview and current outlook, which we went through effectively. I talked about stimulus. I talked about, towards the end of the year, V-shaped recovery is equivalent to vaccines. And we had at that point had good news on Moderna, good news on Pfizer, etc. So looking toward, we already have all-time highs in the NASDAQ, looking to go positive on the S&P 500 for the year, and then push towards new highs maybe the back half of the year. And the same thing with the Dow Jones. The other issue that was on everyone's mind is COVID spikes, declines, implications, and resolutions. So at that point, I went through state by state for the Sunbelt states that were spiking and showed how many of those states at that point were coming off of the boil, meaning they were coming down off their most recent high that happened in early July. But we're actually going to get a bit more granular on that in this week's podcast, VideoCast, because I usually have 3 or 4 TVs on in the background during the day, and it's a constant drumbeat about cases spiking through the roof. It's going bananas. I'm like, what the hell is going on? Like, why is it that in New York, New Jersey, Connecticut, we're down to like nothing, and in these other areas it's going bananas? And I literally found the answer today. And I think it's going to be obvious to many of you, and it's more than just we wear masks now and all of that, but actually there's a lot to it that has changed, which may be very, very good news. But I'm going to hold you into suspense till the latter part of the call, because it's obvious, but it's not talked about at all, and I think it's going to be helpful in getting to a quick resolution moving forward. We talked about the value versus growth. The unique thing that I talked about on the call with her, on the segment with her, was emerging markets. And basically what I was talking about was, the Indonesian demographics are very favorable. They have a very young population. They have population growth. And that bodes well for economic growth. If you look through the last 200 years, you could basically see the growth cycles like in the U.S. with the baby boomers. When the baby boomers were young, you had the bull markets, and then the World War II. So you had the 50s through the, post-World War II, the baby boom till 68. And then when they started their own housing formation from 82 to 2000, those were the two biggest bull markets, post-war bull markets. And that was attributable to that kind of pig in the python type of concentration of large population. And we have it again. So the boomers were 80 million people. Now we've got it with the millennials, 85 million. And everyone's looking at housing starts and demand is going through the roof. And everyone's like, oh, it's because of COVID. Everyone's getting out of the city. Yes. And it was starting before COVID. This trend of housing starts and housing formation was really accelerating in the last 9 months, and COVID just pushed it over the edge. We're in Connecticut. I mean, you're seeing bidding wars, and Connecticut has been in a depression, housing depression and economic depression. It was one of the few states that didn't grow, basically since 2007 on the housing side. So for 13 years, we're still underwater. The state is as a whole. So basically, most of the emerging markets have those favorable demographics, and things are very positive. The difference is, what I told her was that if you look at the emerging market indices, you can effectively buy them for the exact same price that they were trading at 13 years ago in 2007. The difference is, if you look at the math, the GDP of the combined region has dramatically grown over those 13 years, despite being able to buy it at the same price. So you basically get, the most bang for your buck. And usually during those huge periods of consolidation where the underlying fundamentals get much better and the price stays the same, the reversion is abrupt and it's massive. And she was really happy to hear that. And, going on to the segment, I looked at Indonesia. Indonesia's charted alongside the emerging markets. It's basically done nothing for 10 years, the equity indices, and I think they're going to take off. And the other aspect that was intertwined into that was a general thesis that I have around it's intertwined into value versus growth, a move into value, but it's also intertwined into the commodity cycle. So looking at a parallel to the early 2000s when energy and commodities were at multi-decade lows as a basket, we're at the same position now, and things are setting up coming out of COVID as demand returns, as favorable demographics in the emerging markets and in the United States in particular. As far as the developed markets go, our millennial demographics are very favorable for commodity demand. China coming out of COVID, India demographics, India and Indonesia probably have the best demographics for the next 20 years in terms of economic growth globally. So she was really happy to hear that, because I think for the country, it's a stock market show and their stock market's basically done nothing for 10 years. That's probably going to change very rapidly in the next 5 years. And they're going to be part of something like what was seen in the early 2000s, emerging markets boom and commodities boom, which are intertwined. But it will be more led by India, the Indias, Indonesias, Vietnams of the world than what was in 2000 to 2007, largely driven by China and Brazil, etc. So she also asked about, and the other thing that was tied to as well was the short-term trend that has started of a slight dollar weakening. Any continued weakening in the U.S. dollar, which is starting to move closer and closer to consensus. And we talked about maybe 2 months ago on one of these podcasts how the Bank of America survey had managers believing that the dollar was the highest percentage of managers believing the dollar was overvalued. I think since it was since 2003. And during that period, the dollar fell and emerging markets and commodities boomed. And they're at the same level. They were at the same level a couple of months ago when the dollar was at its strongest, and now it's starting to weaken. So all these things play into the benefit of emerging markets over the next 3 to 5 years, commodities over the next 3 to 5 years, believe it or not, inflation over the next 3 to 5 years. And she asked about gold, and I said, that would certainly be part of the basket. I'd prefer to rather own the full basket than just metals. And more than that, I like durable businesses that throw off cash, durable franchises, because the largest, best franchises that pay a dividend will raise the dividend, number one. Number two, they will have the pricing power to benefit from inflation. So, I joked I'm an equities guy, so to a guy with a hammer, everything looks like a nail. But for me, highest quality equities is probably a better inflation hedge over time than just one commodity or even a basket of commodities. Next was thoughts on safety. She said, cash or bonds. And I said, high quality equities that raise their dividend over time and are durable franchises. Because even if you had a contraction, the biggest durable franchises gain share during contraction. So if you can withstand the volatility, i.e. never trade on margin, and just sit through the volatility of the best franchises, when you come out of it, a lot of their smaller competition will have gone out of business and they do even better. So in some sense, you have greater safety being in equities than you would think in bonds, particularly with bonds at historic low yields. Once the yields start to go up, you're going to lose a lot of principal. Cash gets inflated. She asked about cash. Cash gets inflated away over time. So high quality, large equities are your best hedge, I think, both for safety and for inflation in the intermediate term. We talked about banks trading at a discount. For those of you who have listened in, you probably don't want to hear any more about banks, but we're going to talk about banks today because we had earnings this week that came in better than expected on the whole, and still great opportunities there. And we talked about value versus growth. Value outperforming when the recovery looks fast, growth outperforming in the short term when you look like you're having a short-term setback. So that was really a lot of fun. Definitely want to, thank them for having me on, Maria Katarina and Yolaiwan Haryana from CNBC Indonesia. Next, we covered on CGTN later Tuesday night with Mike Walter. Thanks to Mike Walter and Zaina Al-Saib for having me on. And this was about the China recovery. This was CGTN America. And like one of the things that we covered in this was that globally, the theme is that not only in China, but globally, the data continued to come in better than expectations. We referenced the Global Economic Surprise Index from Citibank, as well as the U.S. Economic Surprise Index being at all-time record highs. And we said that, obviously imports, exports, PMI services, PMI manufacturing had all beat at that point. We covered that. Retail sales ex-cinema and ex-large restaurants in China are at or near pre-COVID levels. So why is that good news for us? It's good news for us because, well, one, we sell a lot into China, but two, they are 2 months behind us. In other words, they started their COVID journey basically their cases peaked in February. Ours in the epicenter in New York, New Jersey, Connecticut peaked in April, mid-February and mid-April. So to see them at pre-COVID levels shows us that, we can follow the same path moving forward. Also, their airline seats scheduled are at 64 million domestic in July, which is only negative 5% year on year, which is amazing recovery, which goes to show in a couple of months, if we play our cards right, we can get there. The other thing that I pointed out was that this was on Tuesday, that people were looking for plus 2.5% GDP for the China numbers were to come out on Thursday. And I said that it would likely come in better as all the global data had been coming in better. And sure enough, yesterday it came in at plus 3.2% after being at negative 6.8% in Q1. So that was a positive thing. We talked about the recovery being tied, V-shaped recovery being tied to getting the vaccine. We had Moderna, good data on Moderna that night. We had good data from Pfizer the week before, so that's moving forward. And again, we re-emphasized that all of the other disagreements, the treatment over Hong Kong, the South China Sea, the Huawei, the auditing requirements for Chinese public companies, et cetera, are secondary. The key is, do the terms of the phase one stay in place? And so long as they are, then things will continue to go smoothly, and they have. And sure enough, just 2 days later, on Thursday, China came out and says, we will stick with the U.S. trade deal, but respond to bullying. So, what they're basically saying, the rhetoric was high on both sides this week, but they're going to work their way through, and the administration backed off some hardline points of view, and China backed off, and they said, we're going to continue with our purchases despite the hard rhetoric. So that was a very, very positive thing, and things continue to move ahead on that front. So that was CGTN. And then lastly was Wednesday. I was invited on CNBC in London. This, I guess they're based in London. It's the whole of Europe. And this one we talked largely about banks because it was the day after JP Morgan, Citi, and Wells Fargo reported. And we talked about we talked about the value versus growth. We talked about the COVID cases coming down in certain Sunbelt regions at that point, economic data beating expectations. But the most important thing we talked about was banks. And the case that I laid out, and you definitely want to go through this, was a concept called CECL. CECL is a new accounting standard that went into place that effectively forced the banks to estimate their worst case scenario credit losses for the entire cycle and record them up front. This has never happened before. It usually was on a quarter by quarter basis. You adjust based on how things are going. Here you have to say, if things go to hell, how much reserves do I need? And they took them 100% of those in this quarter, which is why you saw those three banks take, over $25 billion of collective reserves, JP Morgan, Wells Fargo, Citibank. That's the bad news. The good news is that they kitchen sinked it. So the CFO, John Shrewsbury of Wells Fargo, was on 3 p.m. After they reported earnings with Wilfred Frost and Sarah Eisen on CNBC. And he basically said that we believe we've taken 100% of provisions that we're going to need for this cycle, obviously barring some crazy thing. So that is not how it's been historically. So effectively, all the bad news is out, and that's why you've seen, and we're going to walk into it, that's why you've seen a bounce in these stocks since they reported, because there's all of the bad news, the concept of sell the rumor. Everyone was expecting these huge provisions, and then buy the news. We got the bad news. It's out. There's no more sellers. The sellers were all selling in anticipation of the bad news. There's no one left to sell. Now they've said we've basically given 100% of whatever bad news we could possibly guess will come in the next 3 or 4 quarters due to CECL, the accounting change. We had to take it all up front. So now it just comes down to they've set themselves up to beat earnings like crazy moving forward because all the provisions are in place. So that was the key theme of CNBC London. And I wanted to thank Sophie Rose for inviting me on the show. We also covered the Bank of America Global Fund Manager Survey that talked about the most crowded trade being tech, and the contrarian trade being to sell tech and buy banks and oil. That managers only 14% of managers believed in a V-shaped recovery at this point, which gave us plenty of latitude to climb the wall of worry. There's still a lot of pessimism baked in, and the two biggest risks being a second wave of coronavirus and a blue wave in the November election, meaning Senate, House, and the president and the executive branch went Democratic. Those are the two biggest risks identified by managers running $500 billion in the survey, 200 some odd managers. So enjoyed being on CNBC Europe. Thanks again to Sophie Rose. So definitely watch those on your own because there's a lot of information that went into those. The next thing I want to do before we go to our article of the week, there was a really good article I came across that I spent some time on today. But Bank of America put out this article that lists 7 reasons why value may be finally poised for a big comeback. And we've been talking about this for a number of weeks on the podcast VideoCast, but I really like the article because they put out some statistics that were spectacular. The bank noted that from 1926 till now, value investing has handily outperformed growth investing, notching a 1.3 million% gain versus growth gain over the same period of 626,000. So value has more than double the performance of growth over the last basically 100 years, even though it's underperformed since 2007. And a lot of that has to do with rates. But growth has outperformed value by about 8 percentage points since 2007. But over time, 1.3 million% versus 626,000% is a big difference. Now, the people that are growth will say, well, the world has changed. Everything is tech and healthcare, and that's never going to change. But I think that's really taking a short view in the sense, the same story was the case in the late 90s, and then from 2000 till 2007, value and cyclicals crushed growth and commodities and emerging markets, etc. So it has to do with the dollar, has to do with rates, has to do with changes in the cycle, has to do with demographics. There's a lot more to it. There's always been capital-intensive businesses and non-capital-intensive businesses, and they cycle in and out, and they revert to the mean, no matter how good the non-capital-intensive businesses become. It's a question of when does it pay more to invest in labor versus capital, and the cost of capital, and the variables that go into that equation, and the expected growth. So, as Carl Icahn once said on CNBC, he said, you can't tweet your way to prosperity. So at some point, someone's got to pull the energy out of the ground and deliver it and do all that stuff and grow the food and everything else. So here were the 7 reasons, and I'm going to go through this because I just thought it was a really cohesive argument, and it hit on a couple of things that I haven't emphasized in the last few weeks. So since 1929, every time the U.S. went through a recession, value stocks outperformed the S&P 500 for at least 3 months around the absolute low of the economic pullback, according to Bank of America. Additionally, the outperformance by value trend tends to be wide during the first 3 months of outperformance, leading on average by 12 percentage points. So we're right in that sticky point of when this should shift into high gear and start to work coming out of recessions. That I've emphasized quite a lot on media spots and on these podcasts. The second point they made was style cycles are driven by profits, not rates. When growth is scarce, investors will pay up for growth. As growth broadens out, investors become more price sensitive and seek out the cheapest growth they can find. The bank also argued that interest rates have very little impact on style rotations, according to the note. That I would take a little issue with, but I think the point that they said, well, it's a chicken egg thing. It's like, why do rates go lower and lower and lower? When growth is high in the economy, the demand for capital picks up, and that, when the demand goes up, the price goes up, which means the rates go up. The product price, which is money, goes up because there's a huge demand when there's growth and there's an ability to get a return on capital, so people demand more of it. So that's a chicken and egg argument, but I do like the point that they make when growth broadens out, people want to pay less because there's more available. And that again is a supply-demand argument, and that's a nice way of looking at it. He said value is undervalued. Number 4, value stocks trade at a near record discount relative to momentum stocks. 2 standard deviations cheap, Bank of America said. Value has only been this cheap since 2003 and 2008, after which value outperformed momentum by 22 percentage points and 69 percentage points, respectively, over the subsequent 12 months. So again, which we've been saying over and over for the last 4 weeks, coming out of recessions, cyclicals and value tend to outperform, and they're just re-emphasizing this with additional hard data. Point 5, abundance of mean reversion alpha. The wide dispersion in valuation between growth and value stocks usually precedes value cycles. So in other words, this huge spread we have, that's when value starts to outperform. When valuation dispersion has been this high or higher, value stocks have outperformed growth 95% of the time over the subsequent 12 months, Bank of America highlighted. Number 6, I feel like I'm David Letterman, the top 10 list, for those of you who've been around a little longer. Okay, so number 6, anti-monopolistic risks to growth stocks. This is interesting. U.S. oligopoly power has risen since 1998, while the number of firms has dropped considerably. The implications for oligopolies, which tend to be growth stocks, not value stocks, are more regulation and higher taxes, lower valuations due to regulatory risk, and a drop in profit growth, and in some cases, an eventual breakup of some companies, according to the bank. Yeah, I think things like Mark Zuckerberg interviewing Dr. Fauci and criticizing the administration's response to coronavirus is probably not going to help their regulatory issues. I think, you've got Facebook, you've got Google, you've got Amazon. So, this has been a trend. This is not new. It's been moving in this direction for the last 12 months. You see, obviously, Europe has taken action on it. And that's an interesting perspective that I haven't given a lot of weight to with regard to the value to growth rotation or growth to value rotation. I think it's a point well taken. And number 7, Japanification favors value. I don't think we're going to be Japanified, but it says because Japan had a population growth problem, which we don't have. They had a demographic, so they were aging and they weren't letting people in. It's kind of more of a xenophobic type of, just homogeneous environment. It's not big immigration friendly, etc. So we don't have that. But even in the case that you would, because a lot of people make that argument because of low rates and pushing on a string, yada yada, value stocks are poised to outperform. While Bank of America doesn't think that'll happen, it did observe that during Japan's lost decade in the 90s, value was the best performing sector among the standard quantitative strategies. So this is a real compelling argument. And then you had legendary bond trader Bill Gross come out talking value stocks this week. And his point was he looks at everything, to a guy with a hammer, everything's a nail. He's a bond guy, so he looks at everything in relation to rates. He says for value stocks, this discounting effect. Okay, so when real rates decline like they have over the last few years, the discounting of current dividends skyrockets the price, he said. But for value stocks, this discounting effect is much less pronounced because the growth of their dividends was highly dependent on the performance of the economy and would thus offset the benefits of the lower inflation-adjusted yield. It's not clear if growth stocks can continue to depend on the persistent decline in real yield, said Gross, who suggested that the rally in Treasury inflation-protected securities had seen their best days. He noted the 10-year real yield stood at a record negative 80 basis points, tying with inflation-adjusted rates in Europe and Japan. For that reason, value stocks versus growth stocks should be an investor's preference in the near-term future, he said. So, cyclicals, banks, financials, industrials, materials, etc. And you're seeing that across, home building sectors flying. We'll go through some of that data. So So just a unique thing. And then you got Warren Buffett, who's back in action. He did his $10 billion deal. You know, it's funny, on Liz Clayman's show, I also mentioned, we lost time, but the last two big deals Warren Buffett did were both cyclicals. He did $10 billion natural gas distribution, and also the terminal, the Cove Point terminal, which is huge for LNG exports, which is going to be a huge part of the natural gas growth going forward and a big part of the Marcellus story. And then prior to that was the Oxy deal, which in the short term he's getting hurt, but in the long term he's going to do exceptionally well. So his last two $20 billion have been in cyclicals. Obviously he did Apple, which has helped him in the short term, but the cyclicals is kind of where his thinking is. And it's reported that he may have just bought $5 billion of stock back in recent weeks of his own shares, which is basically trades with financials, and they've been trading at a discount to book or discount to intrinsic value like a lot of the banks. And he bought back, it appears, between $4.9 billion and $5.9 billion. We won't know until the reports, but someone reverse engineered the float or shares outstanding, and they came to that conclusion. So he's buying value, and that looks like cyclicals, and his own stock, which is financials. Big holder of banks. Now on to the article of the week, the Eagles long-run stock market and sentiment results. So in this, the reason we chose this song, The Long Run from the Eagles, to embody the sentiment of the stock market this week, the lyrics are, you can go the distance, we'll find out in the long run. We can handle some resistance. So I put the chart of the S&P 500, and we're basically knocking up against the levels in the S&P that will make the S&P 500 positive on the year. So we knocked up on it when we had that huge cyclicals run in May to early June, and then we retraced, and now we're knocking up on it again, and we're just, you know, keep knocking on the door waiting for it to open. And the interesting thing about this short-term resistance that we can handle, as Glenn Frey, the singer, so eloquently sang, we can handle some resistance, is that once we get through this, there's a big gap from early February that effectively takes us back up to about 33.25 or so that needs to be filled. So if we can get through this without retracing this consolidation box we've had for a month and a half, 2 months, we could shoot right through that gap, potentially to new all-time highs, but certainly probably fill that gap and then chop around for a little while into the fall before likely making new highs later in the year or early next year. But so that was that. We went through the shows, and then we went through Wells Fargo. So the title of this section was Sell the Rumor, Buy the News. And you could see how the thesis has been playing out. So a couple weeks ago when they announced they were going to cut the dividend, we put out a long argument on how the last time they cut the dividend was 85% on March 6th of 2009. In the subsequent 2+ months, the stock rallied over 250% after the bad news was out. It basically traded from a huge discount to book all the way back up to book. Right now, it's trading at about, it was trading down to a 38% discount a book. It's come up a little bit. But you can see from this chart that, you know, the bad news came on the 14th in earnings. It plummeted down to 23.75. By the way, the book value per share is about $40 right now. So, dropped down to 23.5. After the bad news, it rallied all the way up to $25.40, and I think it closed today around $25. So it's well up from the $23.75. The bad news is out. The sellers are gone, flushed out. There are no real sellers left. There's no more bad news. They've basically probably taken twice the provisions they're going to need over the next 12 months, and that'll come back to them as, you know, we could effectively be, and I said on a number of the shows, V equals vaccine. We're going to talk about that toward the end of this podcast, but some major things coming up in the next trading day we'll talk about. So I said, it may not be a straight line up, but I anticipate this movie plays out well over time, as it has many times before. I covered this also on CNBC Europe. The whole Wells Fargo scenario, the bad news was out. The lady, looked at me like I had three heads. But, I've had that before. And then 2-3 months later, I come back on and they're like, wow. So just hang tight on this one. And you'll see how that works out over the next few months. Now, and then I kind of made a joke, in case you haven't turned on a TV in the past few weeks, and especially days, this is not a popular point of view. I mean, pick your station, man. But like the sentiment on banks this week, it was like, I can't even think of a bad enough analogy, but it was like, this is the last thing anyone wanted to own. So sure enough, in the last couple of days, they've had a mini rally, and then we'll see if we get follow through over the next few months. But that's that. Here's the note that I put out 2 weeks ago when they announced that they were going to cut the dividend, and I laid out what had happened on March 6th when they cut 85%. They cut 80% this time. They went down from 51 cents to 10 cents. So that yield is still about double the 10-year yield to hold the stock, even with the huge dividend cut. And that's going to save them about $6.7 billion a year. That's going to accrete directly to common equity, to the shareholders. So it doesn't matter. They don't pay out. You don't lose it. It's going to be retained, and they'll pay out whenever they pay it out. That's number one. Number two, it was rumored that they're going to cut 10,000 jobs, which will save of 250,000, 5-ish% of the workforce. And that'll save about $10 billion on top of it. So they're going to save $16.7 billion. Plus, they've already taken 100% of the revisions they have. Plus, their deposit base has probably increased about 25%, and that capital costs them zero. They don't have to pay anything anymore. A year ago, they were competing with CDs. Now there is no competition. So they've got all this free funding. Even if they put it in longer dated treasuries, the Fed's been talking about yield curve control on the short end, not on the long end. So up to the 5-year, the short end they already have, 3-year, 5-year, pinning that down and letting the 10-year and 30-year do what they'll do, which could imply a really steep yield curve on a huge amount of free cash, or free float as I like to think of it. And they could just mint money to the bottom line. So a lot of good things lining up, and all the bad news is out. So love this story. And, you look at the book value over time. In 2004, at the beginning of that recession, it was $10. It grew to $20 by the 2008-2009 crisis. And then to this crisis, it doubled again from $20 to $40. And, over the next 5-10 years, it's probably going to grow to $80. But, they trade in a range from a discount of book, which they're trading at now in the case of Wells Fargo is 35% discount or so, to a premium where it traded up here in 2017, late 2017, early 2018, it traded at a 75% premium to book. So, you have, if you can look out 5-7 years, you've got basically book will probably double again to $80, and the euphoria before the end of the cycle could take it up to $150 stock at that point. But for now, we're just looking for a reversion to book in a reasonable amount of time, the next 6 to 12 months, and that's very hard to see right now. But the other thing is this. If the government really wants to have a strong, sustainable recovery, the number one thing they need to do is take the artificial regulatory asset cap off of Wells Fargo, which is complete nonsense, because it's the biggest lender in the country. If you want the country to recover, you need credit growth. And if you cap your biggest lender, you're shooting yourselves in the foot. And I don't know if people have been thinking about it in that way, but if you look at every single recovery, the correlation with credit growth is very, very clear. And if you've capped your number one lender's ability to lend when they're the biggest lenders to small businesses, to Main Street, to individuals, etc., you just handicap the ability of the economy to recover, which means the government has to pay out more money versus letting the private sector heal itself. So get rid of the cap. Do or don't. I own the position because it's cheap, but this is just common sense. If you want a sustainable recovery, the number one player has to be able to do what they do, which is help the economy by lending to Main Street. Okay, next, okay, we covered that. We covered banks. We talked about the Wells Fargo interview with John Shrewsbury. You can play it here when he talked. His quote was, "We believe that we've captured all the lost content in the portfolio." So you can pull that up there. Bank of America put out their monthly global fund manager survey, which is one of the most important data points that I look at. The three key takeaways I had, again, were conviction on the recovery is low, with just 14% saying that the recovery will be V-shaped. This is a very good thing, particularly when you're up over 40% off the lows, that there's still a lot of pessimism. It means we've got more wall of worry to climb. Cash levels went up from 4.7% to 4.9%. Again, skepticism. And 74% say that long U.S. tech stocks are the most crowded trade in the survey's history. So this is key because the contrarian trade that they're calling for is to short tech stocks and buy banks and energy. Now, in my view, V equals vaccine. So V is code for vaccine. And now that we've got a considerable number of contenders exceeding their timelines on expectations, money is starting to move back into cyclicals like we saw this week. So how is it that cases are going new cases are going through the roof, and yet the market seems relatively calm? Well, hang tight. Towards the end of this, we're going to explain why that is. The market has actually figured out that what you hear on TV and what's happening on the ground, when you parse the data correctly, are actually two different stories. And that's why the market is where it is. So we'll get to that. But the other thing that we pointed out was there is no alternative. This week, we covered a couple weeks ago, but it was basically when you had this percentage of the S&P companies paying dividends greater than the 10-year yield, and it's up to now 80% of the S&P stocks have dividends greater than the 10% yield. The last time this happened was the 2016 crash, the oil crash, and you had a huge rally until 2000 and early 2019 after that. This happened after the Euro crisis in 2011, the debt crisis, and you had a monster rally after the 2011 crash. And it also happened in late 2008, early 2009, and you know what happened after that. So we just had it even more pronounced, which means the recovery can be the exact same thing. This also highly correlates with periods in which you've had a crash. Volatility has ripped high, and it's on its way down. You could actually also look at, I should have pulled it up, but this VIX index chart where they correlate it to the bottoms of the market when you've had these spikes and then they start to come down and you see the rallies afterward, which is where we are right now. We're coming down off a really pronounced VIX. This is also highly correlated to the average true range. So if you take a long dated S&P chart and you put the average true range, so basically when you have a huge move in the market, the average true range shoots up like the VIX. Just think about what happened to the VIX. And as the average true range narrows, you get a longer term rally. It's the exact same thing with the VIX. And the volatility is a function of those wide gap in prices, etc. So the correlation is uncanny. But those are indicators of bottoms, not tops. And that's that. As for this week, couple other takeaways from the global fund manager survey. Again, you can see here overweight tech, underweight energy and banks. That will revert to the mean. The positioning, there was a nice move into the Eurozone over the last month. Eurozone equities as a result of the $750 billion package. A decent starting move into materials, but value is and banks are still unloved. And if those 7 points and my thesis that I've laid out in the last few weeks is correct, that cyclicals and value will outperform in the early stages of the recovery, then over the next 12 to 18 months, this is going to snap back very, very quickly. You also saw the largest overweight in commodities since 2011. The last time that happened, that was again after the 2011 20% correction and slight recession. And then also 2009 coming out of the recession is when you also had that underweight shoot to overweight. And then prior to that was likely 2003. We don't have data back that far. And then the two biggest fears are the second wave of COVID by 52% of respondents and the blue wave. So that is, the election betting odds don't look good, but number one, it's early. Number two, it's unlikely that it'll be a complete sweep regardless of which way the presidency goes. And what we want is gridlock. Whether you have a Republican president or a Democratic president, just make sure one of the houses, either the House or the Senate, is the other party. And that's historically bullish on a statistical basis. And that's what we're talking about as markets. Short term, this was nice to see. The fear is thawing in the AAII sentiment results. For those of you on the podcast, by the way, if we get cut off in the next 9 minutes, if we go over, go to hedgefundtips.com and you can just fast forward the VideoCast. It's a YouTube video all the way to the end, and you'll catch the last 10 minutes or so, but we're going to cover some things you'll want to hear at the end, so definitely check that out. AAII sentiment results went up from 27 to 30%. The good news is the fear is thawing, as well as it's nowhere near an extreme. So when it gets above 40%, that's when we start to want to get a little cautious and maybe start to take some profits because there's a lot of beginning stages of euphoria. We're not there. The bearishness actually went up at the same time to 45% from 42%. So again, there's a wall of worry to climb. Just to look at times, you really don't start to think about tops until mid to high 40s, and sometimes even when that happens, it persists. But we're nowhere near there in the just over 30 here. Fear and greed, same story, although it did shoot up from 53 to from 53 to 63 this week. We would really need to see a number between 80 to 100 before we started to look at what is there that we potentially want to shave. And the active investment managers had to chase back up to 85% after being underweight last week before we moved up again. So the message was, hasn't really changed. We're very constructive. We use any pullbacks to buy laggard and cyclical names that will outperform coming out of the recession. In the interim, we hold everything we have, and we'll shave only in the event that we do hit levels of euphoria that we've not seen since February. We're not close to that yet. And then until next time, you can go the distance. We'll find out in the long run. The lyrics from the Eagles. Okay, moving forward. Okay, so what we're seeing here is the value versus growth, the tech versus cyclicals. I came up with a Ben Graham quote this week that was posted as one of the quotes of the day. And he said, the intelligent investor is the realist who sells to the optimist and buys from the pessimist. So the contrarian trade that Bank of America is talking about to sell tech and buy cyclicals, banks, and energy would be in line with what Benjamin Graham's saying. I said that this had to be nuanced in my article. I don't think it's going to be a zero-sum game either or, just because of the different weights of the sectors that are skewed now. So what I am calling for is, in the early stages of the recovery, an outperformance, but that doesn't have to be fully at the expense of tech. Some tech stocks will crack and crash. Some of these 100 and 200 times earnings, you'll see some blood in the streets. But I think on balance, on a sector basis, I just think that cyclicals will outperform percentage-wise. It doesn't necessarily mean that you're going to have some 2000 crash where Amazon goes down 90%. I don't see anything like that. It's just it's an relative performance play versus an either or. And, for some people are saying, you have to have both. Whereas before they were saying just tech, just growth. Now they're diversifying again, like they said in that article. As the growth broadens out, people will want to pay less and less for the growth once they have more options, and that'll just mean that the ones that were expensive growth will come down a bit to compete with the ones that are getting growth in the growth part of the cycle, coming off of a low growth bar, and it'll kind of rotate in that orderly way, generally orderly way. So that was a good quote. Now, let's talk COVID for a second, because everything that I hear on 4 TV sets in the background is like really bad news. I would say a couple things. Number one is a number of those states, California, Arizona, Texas, Florida, Georgia, etc., they had come off the boil early in the week. They were at lower new cases in those days than they had been previously. I think some of them still retained that downtrend. 1 or 2 of them may have spiked up. That's immaterial. What I think is very interesting is, President Trump actually was saying something, and no one really gives him any credit or listens to him when he says it, or maybe some do, but it's not publicized. And he said, if we did less tests, we'd have less cases. Okay, well, that sounds obvious, but it's such a direct correlation. And someone said, when I discussed it with them, they said, well, the cases are going up faster than the testing, and that's false. So I actually went through the numbers today, and it's not the case. So if you look at, we're looking at new tests versus new cases. So I did a little bit of math. I mean, you can see the picture here, but basically the last day that we have data for is July 16th, which was yesterday. You had 830,000 tests, 830,918, and you got 80,403 cases. It's 9.6% of the tests became cases. Now, that's not to say that 100% of them, you don't get tests in the same day. Some places you do get test results the same day, but most places it takes a week. So there's a lag effect. So then I went back. So I just said, okay, let's just do apples to apples. Let's do July 16th, June 16th, May 16th, April 16th, March 16th. Not to cherry pick like, oh, May 12th was better than May 16th to make my argument. So we just took the 16th of every month. June 16th, you had 463 tests. So your tests have gone up almost 100% in the last month. In May 16th, you had 362,000 cases. April 16th, tests were 163,000. So from April to May, tests doubled. And then again from June to July, tests doubled. And March 16th, tests were only 17,000. So basically, if you take the mean, give or take, the tests, new tests to new cases, it's about 10%, give or take. So that ratio has stayed more or less the same. What's gone down dramatically has been the deaths. So even though the raw number of tests, i.e. cases, so let's just say, for argument's sake, round numbers, 10% of the people tested are new cases. That's the bad news. The good news is the deaths have gone, despite the fact that the testing has gone up 40-fold since March 16th, 40-fold, the deaths have halved from 2,000, and we had a spike up, so I'm giving the spike, from 2,000 a day in the end of April to 1,000 a day right now, despite the fact that the cases, because of testing, have gone up 40-fold. So the good news is we're getting better treating. The point that I want to get to here is that many more people than we know may have this. So assuming a 10% hit rate, so 10% of the people who get tested, let's say, wind up being new cases, we may have a situation where of 330 million people, The vast majority have not been tested. I think there have been 43 million tests to get 35 million cases. Okay, so that's less than 10%. So let's assume 100% you extrapolate that out. 100% of the population actually got tests. You'd have, give or take 25, 30 million people that have actually already had it, and yet we're at 130,000 deaths. So think about that. You've only had 43 million people tested. Assume 330 million people had been tested and the same sample result holds of 10%, which it probably won't be because people get tested by and large are people who potentially suspect they may have it. In some cases it's mandatory, in some cases they do it because it's free. But more or less, if you're feeling well, it's funny. My poker group was like, they had early on, they haven't done it lately, but early on they had like free testing in town, or it wasn't free testing. You'd go, whatever it was, like $100 or $200, but basically free testing. You'd go there, and my poker group's like, are you going to get your COVID test this weekend? I said, well, if I could think of any place I could go to increase my odds of getting coronavirus, that would be it. So why would I go there when I feel perfectly fine? So I think that the important point of this is, let's just say this extrapolated out. You had 330 million people get tested all at once, and it turned out that 10% of them actually had it. Now you'd say, well, people have had it, so it would be less than that. So let's just say 30 million people that probably most are asymptomatic. So you basically have at that point, and the death rate continues to have, because the treatment, the knowledge about how to treat it, and everything is getting better and better and better. People know how to handle it. That death rate's going to continue to plummet as we know more. And more of these cases are asymptomatic. But the assumption would be we'd actually have 30 to 40 million people that have it, that are asymptomatic, that didn't get tested. And there was an article in The Atlantic talking about a new understanding of herd immunity. When herd immunity came out, the consensus was that you needed 70% of the population to achieve herd immunity. And this respected scientist, Gabrielle Gomez, thinks the number is closer to 20%. And she goes through her reasoning of, so go to theatlantic.com and search a new understanding of herd immunity, July 13th. She lays out her case why it's 20%. So if that's the case, and we've got 330 million people times 20%, and hypothetically, if we all had them tested, we have about 30 million people, 33 million people, let's call it 30 million people that already have it, and probably a bunch more people that have antibodies. We may be a lot closer to herd immunity than we even know. What was the light bulb went on when I just couldn't understand every day, record cases, 24 hours a day. And what the headline should have been was record cases, record testing. Look at these numbers. I feel like this is the TSA data. On February 16th, we had 7 COVID tests. On March 16th, we had, February 16th, or let's just pick a random number. February 15th, we had 7 COVID tests, and we had estimated 20 cases, new tests, okay? On March 16th, we had 17,000 tests, 8,300 cases. April 16th, 163,000 tests, And those are new tests. Oh, and the new cases are here. So that's why I have it. So, okay, so March 16th, it was 17,924 tests, 962 new cases. So you can pull up this data yourself. COVIDtracking.com has the new test, and usafacts.org has the new cases per day. Okay, and you just basically, you scroll over it, and I'll show you how to do it here so you can do them on your own and verify the information that I'm telling you for yourself. Okay, so see here, I'm scrolling over on March 16th, 962, that's correct. Okay, here, the new tests, March 16th. Okay, and there it is, 17,924. So March 16th, 17,000 tests, 962 cases. April 16th, tests went up tenfold to 163,000. Obviously, cases went up to 32,000 new cases for that day. May 16th, the tests doubled again, 362,000. Of course, the cases went up. You had 24,000. In June, 463,000 tests, and you had 24,000 cases. And now 830,000 tests, and you had 80,000 cases. That was yesterday. And, you know, these reportings aren't perfect, but if you take the average, about 10%. So we may have already had or have 30 million plus cases in the United States, and a lot more people than that have antibodies. Let's call it another 10 or 20 million. That takes us up to 50. It's not quite 20%. 60 million we would need for herd immunity if you believe Gabriel Gomez's thing. So there are a lot of things that are happening here, but the record cases is, if we had tested 830,000 people a day in March and April, we probably would have got the same numbers. So we do have to keep that in perspective. The good news is the treatment and the death rates are going down. But when these numbers keep coming out, even though some of these Sunbelt states are now coming off the boil like we did in the tri-state area, and wearing masks matters, you know, in whenever you're out in public in crowded places, certainly wear the mask. But the numbers, it's like the correlation between record cases is also correlated with record testing, and you have to keep that in mind. And that's in many senses good news, because we're getting close to that 20% threshold. Now, you can argue and say, well, Gabriel Gomez in the Atlantic, who's featured in the Atlantic, is wrong, and that's a debate worth having. But as we move forward, this is some important information, and I did want to emphasize it just because of all the reporting that's been going on this week. Okay, moving on to the economic data this week. Okay. What did we have here that stood out? First off, core CPI came up a little bit more, so there's some demand coming back in. Was 1.2 versus 1.1 estimates. Not a huge jump. The CPI index jumped just a hair. No real inflation, but just a hair. Remember, the symmetric target is over 2% for a sustained period of time. We're not even close, which means they got to hold it at 3%, which means they're in the market doing $80 billion of bonds, treasuries, and mortgage backs for the foreseeable future every single month. They're keeping the pedal on the metal till they get full employment, until they get sustainable, they meet their price targets, which they're nowhere near. There was a big draw in energy stocks this week. A big crude draw. On the API, you had a negative 8 million barrels. On the EIA, you had... where is is it? That's distillates. 7.5 million barrels draw when there was a 5.6 million build last week, and estimates were for a negative 2 million. So the Rystad data that I showed you 3 weeks ago when I said we were going to inflect because of these cuts, it's happening. So keep that in mind, and we're going to actually talk about the cuts this week because it was confusing how they reported. It was actually bullish what they did. They're actually cutting more than they said they were going to cut in the original plan, and we'll talk about that in a minute. Let's just run through some data here. We did CPI. We did the car sales were no, that's Indonesia. Manufacturing production was up, beat expectations. We did the draw. What else here? Continuing claims, jobless claims were better than expected. 17.6 million. It was down to 17.3. Obviously, everyone wants to see this go lower. Core retail sales jumped again, 7.3% against 5% expectations. Initial jobless claims were missed. They were 1.3 instead of 1.25. Philly manufacturing was, and that was probably from some of the new shutdowns in some of the Sunbelt restaurants, that is. Philly Fed manufacturing beat expectations, 24 versus 20. Retail sales jumped again. They jumped 18% last month. They jumped 7.5% this month after expecting 5%. Ex-gas, again, up 6.7% against 4.2% expectations. Less natural gas storage than expected, meaning more demand. And building permits missed by a hair, but were up month on month. Housing starts beat expectations, 1.18 million versus 1.16 versus 1.0 last month. That was huge. You saw the home builders. Consumer sentiment fell a little bit, probably because people are worried about all this reporting about record cases. Record testing, and record cases, but record testing and record low deaths relative to new cases, record mortality rate relative to new cases. So it's okay to report the data, but report it comprehensively so people can understand what's going on. If you increase tests 40-fold, you should expect to increase cases 40-fold. And that's the bad news. The good news is, we probably could potentially have 30 to 50 million people with it or with antibodies, asymptomatic, and closer to herd immunity, even before we get the vaccine, which I got news coming on that before the end of this call. Now, the OPEC was reported as they're cutting their cuts, but that's false. The original plan was 9.7 million May and June, then go down to 7.6 million from July through January, and then from January of 2021 until April of 2022, it's supposed to be 5.6 million barrels a day cuts for a year and a half. And that's what the Rystad data was based on. That what the plan was based on. So everyone said that they're stopping doing cuts this week, but that's false. What they actually did was, they said was, instead of cutting 7.6 as was the plan, we're going to wind up cutting, based on the calculation, including the reductions from countries compensating for overproduction, will be at 8.1 to 8.2. So originally the plan was 9.7 for 2 months. It actually wound up being a little bit more than that because Saudi and Russia did more. If you remember, it went over 10. So now instead of cutting 7.6 until January, it's actually going to be 8.1 to 8.2 until January. Way more than was anticipated in the plan and the expectations in the Rystad data that I put out 2-3 weeks ago that showed the inflection in mid-June, which is reflecting in the weekly crude draws. And then 5.6 from January through January 2021 through April 2022. So they're on track with their plan, and they're not going to play that game that almost blew themselves up a few months ago. So that's OPEC. Couple last things. Earnings. Pepsi on Monday blew it out of the park. Great job on snacks. Beverages were down a little bit because of the quarantine, etc. Just want to cover some of the key ones. JP Morgan beat, Citi beat. Wells, we've belabored that they took huge provisions. Probably what will turn out to be 2 times what they need for the next 12 months, but the CFO said at least 100% is provisioned in, so now they've set themselves up to beat, and trading at a discount to book, which the others are less so there's better value there. And what would happen if the administration figured out that their recovery plan was being destroyed by an arbitrary regulatory asset cap that they don't need because they're more than well capitalized, as we found out in these stress tests? Then they removed that asset cap, kept the dividend cuts, kept the prohibition on buybacks until they're going to build back $6.7 billion of equity capital from the dividend cuts, probably more from the buybacks as they start growing. They're probably going to gain $10 billion from trimming 5% of their workforce, and you let them lend, they're going to be a money machine. But more than that is they're the biggest lender in the country that's going to lend more to Main Street and consumers and small businesses to get this, and real estate, to get people into houses and to get this recovery flying. That would be a good thing. So other banks, First Republic beat, Delta missed. We know why. That'll turn around. Taiwan Semiconductor actually beat. Goldman Sachs beat. US Bank Corp beat. I mean, what you see, I'm just going to scroll down. What you see here is a lot of green. A lot of green relative to red. A lot of green. Domino's crushed it. Obviously, we know why. Everyone's sitting at home getting. JB Hunt Transport beat. That's good to see. Trucking. Home Bank Shares, another bank beat. Another bank beat. Bank First missed on revenues, beat on earnings. West America Bank Corp beat. Okay, then on Friday we had BlackRock beat. We saw that this morning. State Street beat. We saw that this morning. Banks were off a little bit today because of rates came in due to the record cases, which should also be record testing. That's actually real. I thought that was just a headline. I thought that was just a mantra. The data is so conclusive. A 40-fold increase in testing should lead to record cases. Deaths continue to plummet. We're basically we'll probably be at the inflection of herd immunity by the time we get the vaccine, which is going to be sooner than we all expected. Okay, so that was earnings. Earnings on the S&P 500. 73% of S&P companies have reported a positive EPS surprise. That's higher than the 10-year average, which I think is in the mid-60s. And 78% have beat on revenues. Earnings for 2021 have stayed above $63 for the S&P. And if you recall, we traded up to $3,400 on the S&P on $163 of earnings in 2019. So that means we can fill that gap. We can go to new highs by the end of the year as these numbers stay in pat. The other two good things, catalysts we have coming up in the next week, Secretary Mnuchin is working on a stimulus package. It'll be over $1 trillion. I think it's important. They're going to do they're going to try to do the direct stimulus payments, which the Democrats want. I think that'll be just good for mortgages. That'll be good for credit cards, so the default rate stays low in the short term until everything comes back, until we get a vaccine and everything rock and rolls. Treatments are getting better. They're thinking about extending the expanded unemployment. I think there'll be a compromise there. It'll probably be less money so that people that can go back to work will want to go back to work, but those who can't get a job, they'll have more than they would have just from state, but I don't think they're going to keep them at 600. We'll see. We'll see what happens. But it's going to be another trillion and a half in the economy, and that's more than enough to hold us over for the next few months until we get the vaccine or a much better treatment. But the vaccine has a key turning catalyst point on Monday. The AstraZeneca Oxford vaccine data comes out, and the Oxford vaccine has already begun final stage testing. AstraZeneca has said it may begin delivering doses of the vaccine to the UK as early as September of this year. That is a month and a half away. September. 6 weeks. That is mind-boggling. And if that data comes in well on Monday, the market has to sniff that out. I mean, that's 6 weeks away from UK, so figure worldwide is by fourth quarter. Then you've got Pfizer, you've got J&J, you've got Moderna, BioNTech. Those are all looking like end of October, fast track, and fourth quarter, tens of millions, first quarter, hundreds of millions, and billions of doses by 2021. But the market will discount this. Once the data is there, and I discussed this on the CNBC, she's like, well, isn't the market already pricing that in? No, the market's not pricing that in. We priced in a bunch of treatments that, were less good than expected. Obviously, remdesivir has gotten better, but we don't have a silver bullet treatment as of yet. But now it looks like we may get a vaccine before we even need a treatment at the pace this is going. So Monday is a very big day on the vaccine front, because if it means people are starting to get vaccines in the developed world as early as September, that's, probably 12 months ahead of expectations just a month ago. And businesses can start to plan for that. And once people start to understand the data better, that record cases as a result, yes, it's a result of people not wearing their mask, but now all the retailers said you got to wear a mask to come in, Walmart, etc. So that's a good thing. So that'll help the transmission. And people seeing other, people around them get it, they'll say, oh, I don't want to get it. That happened in New York, New Jersey, Connecticut. But if the correlation wasn't so tight between record cases and record testing, I'd be scared, because that's what it sounded like this week. But the fact that testing has exploded, I mean, it just keeps doubling and doubling and doubling. Of course, cases are going to move up commensurate with that. But deaths are moving against that, meaning you're getting a much, much lower mortality rate. So all in all, it's good news. Would we like to see testing go up 100-fold and cases stay flat? Yeah, of course we would. But realistically speaking, it's in correct proportion, and the thing that matters, which is deaths, is plummeting. So we still have to practice the Holy Trinity. You got to wear a mask. That's, the guy who runs Salesforce, Mark Benioff, said if everyone wore a mask, we would get rid of COVID in 3 weeks. I don't know if that's true or false, but I don't think it would hurt to try. What if that's true? What if it's false? What if everyone says, okay, every time I leave my house, I'm going to wear a mask for the next 3 weeks, and we just tried it like an experiment, and 3 weeks from now, it turned out to be complete BS. Like, the guy runs a Salesforce company. My guess is he's consulted with experts to make that assertion, but let's just say he's wrong. Did we lose anything by doing that? Absolutely not. But what if he's right? What if we all did it for 3 weeks, and rather than everything turning around in September or October when we get the vaccine, it turned around in, early August, because what we did in New York, New Jersey, Connecticut, where cases have plummeted, people do all around the country and all around the world, and cases plummet everywhere. And then it's more like a H1N1 situation or a swine flu, where we didn't even need the vaccine by the time we got it. Now, I think in this case, we're all going to wind up, having it and using it. But, Holy Trinity, wear the mask in public, indoor, crowded spaces, wash the hands, social distance, and we're off to the races. So I'm very positive on the outlook. I went through a lot of stuff this week. I hope you found it helpful. Next week, we're going to be back a day earlier. I think the podcast will be out on Thursday because I'm going away for a few days with the family, but we'll get it out earlier. It'll probably be a bit shorter. So I made this week's a bit longer to make sure you have everything you need to help in the week ahead. And let's everyone have a great weekend, and we'll see you back a little bit earlier next week. Thanks for tuning in.